Hello, everyone. Welcome to our financial literacy training. Today, we'll be diving into the basics of managing personal finances, understanding the importance of investment, and learning how to empower ourselves through informed financial decisions. This presentation will hopefully inspire you to expand your understanding in this field. Whether you're a beginner looking to navigate the complexities of the financial world, or if you're seeking to refresh your knowledge, this presentation will lay the groundwork for a solid financial future. So, let's get started. Let's take a quick look at the agenda. We'll start by understanding the cornerstone of personal finance, budgeting. Next, we'll explore the two pillars of financial growth, saving and investing. We'll also look at a number that can open doors to opportunities or close them, credit scores. Then, we'll talk about debt, often looked at negatively, but when managed wisely, it can be a tool rather than a trap. Finally, we'll cover insurance, a safety net that can protect you and your assets from life's unforeseen events. Let's dive right into our first topic, budgeting. Imagine budgeting as mapping out a plan for your money. Just like a map, budgeting helps you keep track of where you are and guides you to where you want to be. It's the tool that gives us the power to make smart, informed decisions about how to allocate our resources. Budgeting has many pros. Firstly, budgeting allows you to take control. Like having a bird's eye view of your finances, it enables you to see the bigger picture and make adjustments as needed. Secondly, it helps you track your progress by knowing exactly how much money you have at any given time. You can avoid the stress of unexpected shortfalls. Thirdly, budgeting is your tool for saving. By setting aside money for your goals, you're actively working towards them every day rather than just hoping they'll happen. And lastly, it's about setting and achieving your financial goals. Whether it's buying a new car, saving for a vacation, or preparing for retirement, budgeting is the foundation that can help you get there, step by step. Moving forward, let's talk about the two key components of budgeting, income and expenses. Income is the money you receive. It includes any pocket money, wages, bonuses, dividends, or any other additional income you might have. Knowing your total income is the starting point for any budget. Expenses are what you spend money on. These can be fixed, like rent or mortgage payments, or variable, like dining out or entertainment. The goal is to have a clear understanding of where your money goes each month. To effectively track your income and expenses, there are several tools at your disposal. You can use free or paid smartphone budget apps like YNAB, Pocket Guard, Empower, and Honeydew, which are convenient and often come with features to categorize and analyze your spending. Spreadsheet programs such as Google Spreadsheet and MS Excel are a simple and traditional method that works well for many. And for those who prefer a more tactile approach, receipt jars can be a great way to visualize your spending. This visual represents a fundamental budgeting principle, often referred to as the 50-30-20 rule. Basically, it says that from your income, 50% should be directed towards needs. These are the essentials, the non-negotiables that you require to live, like housing, food, healthcare, and transportation. 30% is allocated for wants. These are the things that you enjoy but can live without if necessary. This includes dining out, entertainment, and those little luxuries that make life enjoyable. The remaining 20% should go towards savings. This is crucial for your financial security and future. It's the money you set aside for emergencies, a retirement, and other financial goals. Now, we understand the importance of categorizing our spending, but how do we actually create a budget? First, you start by listing all the money you receive. This includes your pocket money, salary, any side income, and irregular incomes like bonuses, interest, or dividends. Once you have a clear picture of your income, make a list of your expenses. Remember to include both your needs and wants as we discussed earlier. The next step is to compare your income and expenses. This is where you identify if you're living within your means or if you need to make adjustments. For example, if your expenses are consistently equal to or more than your income month over month, then maybe it is time to rethink if your spending is reasonable in comparison with your income. Based on this comparison, adjust your spending. This may mean cutting back on non-essential wants or finding ways to boost your income. Finally, implement these changes into your daily life. A budget works only if you stick to it and regularly review and adjust as your financial situation evolves. Monitoring the budget and correcting course at least once a month is a good idea. As we continue our discussion on savings, let's address a fundamental question. How do we determine the amount we've saved? It's simple math. The amount you save is essentially what is left when you subtract your expenses from your income. In other words, savings equals income minus expenses. As an example, let's say that you get $500 from babysitting every month as your income. You spend $300 on your needs and wants. Then, your savings would be $200 since you subtract your expenses, needs, and wants from your income. Setting financial goals is a vital step towards achieving financial stability and success. To ensure these goals are effective, we can use the SMART acronym. S stands for specific. Your goals should be clear and specific, which will provide you with the direction and motivation you need. For instance, instead of saying, I want to save money, specify, I want to save $1,000. M is for measurable rather than vague. You should be able to track your progress quantitatively. This helps you stay focused, meet your deadlines, and feel the excitement of getting closer to achieving your goal. A represents attainable. Your goals should be within your reach. It is good to dream big, but remember to start small. R stands for realistic. This means setting goals that are within the realm of reality and that you're willing to work towards. They should stretch your abilities but remain possible. And T is for time bound. Every goal should have a deadline, 1 month, 1 year, etc. This creates a sense of urgency and can spur you to action. Transitioning from budgeting. Let's delve into the next crucial components of financial literacy, saving and investing. This represents the balance between the safety of savings and the growth potential of investments. On one side, we have savings, which are typically associated with lower risk. The assets are often risk-free or insured, like FDIC insured bank accounts, meaning the chance of losing your money is practically non-existent. However, the trade-off for this safety is lower returns. The interest rates on savings accounts are usually modest, especially when compared to potential investment returns. On the flip side, we have investments, which come with higher risk. The possibility of losing money is greater because investments can fluctuate in value or even drop to zero. This includes stocks, bonds, and real estate, among others. But with this higher risk comes the potential for higher rewards. Over time, investments can significantly outperform traditional savings in terms of growth. Normally, the more the risk is, the more the reward is. If you are offered a high rate of return, make sure to evaluate the risk before accepting the offer. When we talk about saving, it's crucial to understand where and how you can save your money. Let's look at 4 common financial tools. All of these are called deposit accounts and are insured by FDIC up to $250,000 per bank per account type, and so practically risk-free. Firstly, we have a savings bank account. It's a reliable place to store your money, and while it does pay interest, the rates are relatively low. There may be monthly fees, minimum balance requirements, and restrictions on withdrawals. Then, we have the checking account, which is designed for your day-to-day transactions. While it offers great flexibility with no limits on withdrawals or minimum balance requirements, it usually does not pay interest or pays minimal interest. Next, the money market account. This type of account typically earns higher interest based on current market rates and is a good option if you're looking for better returns while still having access to your funds. There may be monthly fees, minimum balance requirements, and restrictions on withdrawals. And finally, the Certificate of Deposit, or CD. When you're able to set aside money for a longer period, a CD can be a great choice. It locks your money at a fixed interest rate for a predefined term. But remember, withdrawing funds before the term ends may result in penalties. Turning our attention to investing, there are several avenues to consider, each with its own set of characteristics and risk levels. First, we have stocks. Buying a stock means you own a piece of a publicly traded company. Stocks are bought and sold on stock exchanges, and they offer the potential for high returns. However, they're also subject to market volatility, so the value can fluctuate significantly, or you could lose your investment completely. For example, you could buy a stock of Apple that would make you a minority owner of the company itself. If the Apple stock price rises, you make money, and if it falls, you lose money. The stock price reflects the performance of the company. You can look for stock online with a ticker symbol, e.g., AAPL is the ticker symbol for Apple. Then there are bonds. Considered fixed income securities, bonds represent a loan from you, the investor, to a borrower like a corporation or government. Bonds pay interest at regular intervals and are typically considered a lower risk investment compared to stocks. For example, if Tesla wishes to raise capital for a new factory, it could issue a bond which will be purchased by investors who will lend money to Tesla and in return get interest and repayment of their loan amount after a particular term. Next are mutual funds. These are collections of stocks, bonds, or other assets managed by financial experts. By pooling your money with other investors, you get diversification, which can help manage risk. They're a popular choice for those who prefer a hands-off approach to investing. For example, a mutual fund called Fidelity 500 Index Fund invests money pooled from different investors in 500 major public stocks traded on the stock market. Lastly, real estate involves purchasing property to sell, rent, or finance. It can provide a steady income stream and potentially appreciate in value over time. Real estate investing requires more capital upfront and can be less liquid than other investment types. Real estate market is also very cyclical and typically follows the economic cycles. One of the most powerful forces in finance is compounding. It is the process where the interest you earn on your savings or investments also starts to earn interest, leading to your money growing at an accelerating rate over time rather than a constant rate. In other words, compound interest means interest on interest. As the illustration shows, if you start with $100 and earn a 5% interest rate per year, look at how the amount grows. After the first year, you have $105. After the second year, you have 5% on $105, which is $110.25, giving an extra 25 cents due to the effects of compounding. By year 5, you're not just getting interest on your initial $100, but also on the interest that's been added each year. This is why you see the amount jumping to $127.61. Not just $125, which would be the case if the interest was simple instead of compound. The key message here is the importance of starting early. The earlier you start saving and investing, the more time your money has to benefit from compounding. As we explore different investment opportunities, let's move on to investing in your education. The acronym ACHIEVE breaks down the steps to make this investment count. A is achieve your goals. Start by assessing what you want to accomplish through your education. Setting clear goals gives you direction and motivation. C is choose your educational path wisely. With countless learning opportunities available, select a path that aligns with your career aspirations and interests. H is have a plan. Outline a strategy for your education, including milestones and a timeline. Planning helps you stay focused and on track. I is invest time. Dedicate time to studying, learning, and skill development. The time you put into your education is just as important as the money you invest. E is engage actively. Be involved in your educational journey. Participate in discussions and apply what you learn. V is value resources. Make use of all the resources available to you, whether that's books, online courses, mentors, or networking opportunities. E is embrace growth. Stay open to new ideas and be willing to continuously learn and adapt. The landscape of knowledge is always expanding. Let's shift our focus to credit scores and what they really mean. Think of a credit score as a grade that measures your credit worthiness. It's like a report card for your financial habits. Credit means the borrower borrows money from a lender with the agreement to pay it back later. A credit score ranges from 300 to 850, with higher scores indicating a better credit history. This score is calculated based on several factors, which we will discuss shortly. Now that we've established what a credit score is, let's talk about what is considered a good credit score. The goal for anyone managing their credit should be to aim for a score of at least 670, as this is generally considered the threshold for a good credit rating. So, just like striving for an A+ in school, aim for a high credit score. It's a clear indication to lenders that you're responsible and reliable when it comes to managing money. Your credit score is like a financial passport. Banks, lenders, and landlords look at it to determine your financial reliability. It answers the crucial question: can you be trusted to repay a loan, manage a credit card, or make rent payments on time? In essence, a good credit score can mean saving thousands of dollars throughout your life. It can also be the deciding factor in approvals for loans, credit cards, and even rental applications. It's a number that can carry significant weight in your financial journey. Understanding what affects your credit score is crucial for managing and improving it. There are several key factors to be aware of. Firstly, bad payment. History affects the score negatively. This means if you don't repay your loans or credit card bills on time, lenders won't trust you. Next, credit utilization. This refers to how much of your available credit you're using. High utilization can signal to creditors that you may have trouble managing credit, and so you are a risky client. Then we have length of credit history. Generally, a longer credit history is viewed positively because it provides more data on your spending habits and repayment reliability. Too many hard credit inquiries. When you apply for a loan, a hard inquiry is recorded on your credit report. Too many inquiries in a short time may negatively impact your score. And finally, credit mix. Having a variety of credit types like credit cards, installment loans, and a mortgage can be beneficial because it shows you can handle different types of credit. Building a solid credit score is a process, and maintaining it requires attention to detail. Here's a straightforward guide. These steps are typically only available for ages 18 plus, but they are something everyone should be aware of. B, begin by opening a bank account. It's the first step in establishing your financial footprint. U, use a secured credit card to start creating your credit history. Secured cards are backed by a cash deposit you make up front. The deposit amount is usually the same as your credit limit. I, implement credit wisely by making small purchases and paying them off each month. This demonstrates your reliability as a borrower. L, look out for errors on your credit report. Mistakes can happen, and keeping an eye on your credit report can help you catch and address them promptly. D, develop good credit habits. This means keeping your credit utilization, how much credit you use compared to how much you have, low, and being cautious about opening new accounts too frequently. Remember, a good credit score is your ticket to financial opportunities, and following these steps can help you achieve and maintain a strong credit profile. Let's move on to our fourth topic, debt. Let's take a moment to demystify debt. Simply put, debt occurs when you borrow money from a lender with the agreement to pay it back later, along with additional interest. Debt is what we referred to as credit in the previous slides. There are various reasons why one might incur debt. For instance, needs dark wants. This can include taking out loans for buying a house or a car, or using credit cards for everyday purchases. Education. Student loans are a common form of debt for many, considered as an investment in one's future earning potential. Unexpected expenses. Life can be unpredictable, and sometimes debt is used to cover unforeseen costs like medical bills or emergency repairs. It's important to recognize that not all debt is bad. The key is to use debt strategically and ensure that it is manageable within your budget. Understanding the landscape of debt is key to financial literacy. Let's explore the various types of debt characterized by the acronym CAMPS. C for credit debt. This is the amount you owe when you use a credit card for purchases. It can have high interest rates if not managed properly. A for auto debt. When you take out a loan to buy or lease a car, you're dealing with auto debt. It's a secured debt, with the car itself often acting as collateral, meaning the lender can take away your car if you fail to repay the loan. M for mortgage. This is likely the largest debt you'll take on. A mortgage is the loan you use to pay for your home. The home is the collateral for the loan. P for personal debt. These are loans taken for personal use, such as covering a vacation or consolidating other debts. These are typically unsecured, as there is no collateral backing these up. S for student debt. This refers to loans taken to cover the costs of education, such as if one wants to go to some college but doesn't have enough money to pay tuition. These are unsecured as well. These may require a cosigner who takes responsibility to repay if the student is unable to pay. Interest is a fundamental concept in finance that affects both saving and borrowing, and is tied to debt. Simply put, interest is the extra money you pay to the lender when you borrow money. For instance, when you take out a loan or use a credit card, the lender charges you interest for the privilege. The amount of interest you pay depends on two things: the interest rate and the length of time you borrow the money. Higher rates and longer borrowing periods mean more interest paid. Lenders charge interest because lending money comes with a risk, the risk that the borrower might not repay the loan. Interest compensates the lender for that risk and for their action of parting with their money, instead of using it for other purposes, also called opportunity cost. Interest is how the lender makes money on the lending transaction. Typically, unsecured loans have higher interest rates as there is no collateral to liquidate in case the borrower defaults on the loan. Interest payments can add up to a significant sum over the life of a loan, but there are strategies to lower these costs. Let's look at how you can reduce the amount of interest you pay. Refinancing is a powerful tool. It involves replacing an existing loan with a new one, often with a lower interest rate. Loan consolidation can simplify your finances by combining multiple debts into a single loan, typically with a lower overall interest rate. It can also make payments more manageable. Another effective strategy is to pay off your debt early. By doing so, you reduce the amount of time interest can accrue, potentially saving you money in the long run. Lastly, maintaining a good credit history is crucial. It can lead to lower interest rates when you borrow, as lenders see you as a lower risk borrower. And for our last topic for this presentation, we have insurance. Insurance is a key component of financial planning, providing protection against unforeseen events. Let's break down the basics of how insurance works. At the center of insurance is the insurance policy, a contract between the insurance company and the policyholder. The insurance company writes the policy to protect a valuable asset such as a home, which the policyholder owns. The policyholder can be anyone, like you or me, who has something that they want to protect, which is why they insure it. The policyholder pays a premium, which is usually set at regular intervals like monthly or annually. This premium is the cost for the insurance coverage. In the event that the insured asset is damaged or lost due to covered reasons, such as natural disasters or theft, the insurance company provides a payout. This payout helps the policyholder manage the financial impact of the loss. For example, I can protect my car by buying insurance on the car from an insurance company like Geico. I pay a premium amount to Geico to keep this insurance. If the car is involved in an accident, Geico will pay for the required repairs. As we've discussed, insurance serves as a safeguard in various aspects of life. Let's explore some of the key types. Auto insurance provides coverage for your vehicle. This includes protection against damages from accidents, theft, and other liabilities. Property insurance protects physical possessions like your home. It covers losses from events like fires, storms, and vandalism. Health insurance helps cover the cost of medical expenses. It's essential for mitigating the high costs of healthcare and maintaining your well-being. Disability insurance offers income replacement if one becomes unable to work due to disability or illness. It ensures financial stability when one is not able to earn an income. Lastly, life insurance provides financial protection to one's family in case one passes away. It's a critical component for family financial planning, helping ensure that one's family's financial needs are covered. It's important that you recognize the most valuable asset you have, yourself. Your well-being is central to every aspect of your life, from your ability to earn an income to achieving personal success. Health insurance is a critical part of safeguarding this asset. It ensures that you have access to the care you need without the burden of overwhelming medical costs. Think of it as a maintenance plan for your health, keeping you at your best to face life's challenges. Life insurance is another key component. It's not just about protecting your loved ones in your absence, it's also about peace of mind for you, knowing that they will be financially secure. Your salary is the financial recognition of your work and talents. It's what you use to build your future, whether that's through saving, investing, or spending on life's pleasures. And finally, success is the culmination of your hard work, dedication, and the wise management of your resources. It's both a personal and financial goal, reflecting the value you create in your career and personal life. So, invest in yourself, protect your assets, and remember that your well-being is the foundation upon which all other successes are built. Thank you so much for listening to our presentation. We hope you liked it. We would love to hear your feedback so that we can improve on our presentation. And so please respond to the survey email we will send after the call.